Hi, Mark Anderson here, mortgage banker with Paramount Bank. I do lend in all 50 states, and I would love the opportunity to earn your business. Before getting into this video, I wanted to send kind of a general thank you out there. When I first started doing these daily update videos, I was doing it because I saw a lot of basically misinformation being spread around, or really just an incomplete story of what was going on with this low interest rate environment in your basic news outlets. There was a level of I guess ignorance, I guess is the only fair way to say it, about what drives rate changes, what matters, what you want to look at. And I just felt it was going to be important, and maybe some people would find it useful to provide some level of context. Now, I've got to say, I do not hold an economics degree. This is just the world that I've lived in for 15 years as a mortgage banker, and I have educated myself along the way, but I am not an expert. But even as a non-expert, as somebody in the field, I just saw a lot of information out there that wasn't accurate. Basics like the Fed cut rates, therefore mortgage rates go down. Things like that are so popular and they're so wrong that I just thought it would be important to put these videos together. Now, the thank you is for the fact that, kind of surprisingly, I have 6 new clients that I basically met through doing these videos. So I sincerely appreciate anybody that's taken the opportunity to reach out to me. I've made some good relationships so far just off of doing these videos. So I really do appreciate that. On to today. What is happening today? This is the bond graph for today. And what I'm going to talk about is an interesting phenomenon. The biggest underlying variable that's controlling mortgage pricing right now is the Federal Reserve. Now, it is not what they've done to cut short-term rates, but it is what they're doing to inject money into the bond market. Now, there's an interesting phenomenon that we have now seen repeated basically 3, maybe 4 days in a row now. Since the announcement of the blank check, where the Fed has said they are just going to pump as much money as is needed into the bond market to provide liquidity in that market, there's been a very clear pattern. And I'm going to tell you the best time to lock your loan, as long as this pattern continues, which of course there's no guarantee that this pattern will continue. But this is at least what we've seen so far. The Fed in the beginning of the day, that's when they start pumping all their money in. Now, at some point in the day, they turn off the spigot, and there is an immediate reaction in the bonds. And you can see that right here. So bond prices throughout the day, they're on the high side. To give you an idea of a relative comparison, just to tell you how good things are now versus, say, last week, this is the 5-day picture. So this is showing pricing for basically this week versus last week. And the big jump in bond prices is why we have better, more favorable interest rate options now. But here is the pattern I wanted to talk about. The Fed turns the spigot on, and right here, that's when they turn it off. And the bond prices drop like a rock as soon as that happens. Now, we have seen negative price changes, and by negative, I mean actually worse rates. We've seen, it looks like 12 lenders worsen their pricing from their initial morning rate sheets. 5 made them better. Most of these price changes here happen right here as a direct reaction to that. So what this says to me is, as long as the Fed continues this program, and as long as there's not some other externality that starts monkeying around with the way that this thing works, it looks like your best time to lock is going to be in the morning. Because the capacity on a day-to-day basis, the Fed does turn that spigot off, and we do see price changes for the worse, it looks like in the afternoon. So again, as I've said many times during this video series, it pays to have a relationship set up with a lender. If you are not at your target price right now, it is going to pay big time to get your application in the door so that your loan officer can lock the rate at the right time. Because from morning to afternoon, we're going to see different pricing. Now, the actual impact on rates, it's not huge. This dip makes it look just dramatic. But again, the relative price of these bonds versus last week, this is when the rates were worse. This is now. Yes, it's dramatic on a single day to see that drop, but the overall changes in the actual rates offered in the afternoon are not, let's say it's not significantly different than what was available in the beginning of the day. But if you're one of those, I've talked to a lot of people that are in this boat right now. The rate you've got right now is a good rate. I don't know, maybe you're sitting at 3.5% on a 30-year fixed. It was a good rate when you got it, and it's a pretty good rate now. You might be in a situation where you've decided, man, I just need to get 3.0 with no closing costs in order for me to go through the process of getting that refinance done. If you're in that boat, again, get the application in the door, get a hands-on loan officer like myself that can basically click the button as soon as your target price is reached. One thing I'm going to throw out there is a piece of software that I use, and I have a bunch of clients in this right now. I actually receive an alert when a target price is reached for an individual client scenario. And I have used this very effectively over the past, well, I guess 3 days. A week seems like it's gone way longer than that. I've used that very effectively to get people locked in when the time is right for their scenario. So that is just an interesting pattern that I saw today. I will keep you updated. I'm going to continue this video series. Again, thank you again for anybody that has reached out to me. I sincerely appreciate your business and for the opportunity to work with you. If I can be of any assistance to you, call, text me anytime. Thank you very much.